You're listening to Stellar Success, Leveling Up for Medical Pros with Dr. Tudor Francu. Join us as we explore how medical professionals can achieve stellar success in all areas of life. It's time to level up.
Hi, Dr. Cobb. How are you?
Fantastic. Thank you so much for having me.
Thank you for coming. You are an interesting guest to this podcast because you're someone who went along the way on a full professional career in medicine. And then you had kind of veered towards real estate investing. So I want to kind of touch both aspects of your life here. But first of all, just let people know a little bit about your history, how you started, what happened along the way, and what are you doing now?
Yeah, so I grew up in Texas on a farm and ranch, and started investing in land early on in life, and went to medical school. Did my orthopedic residency at the Mayo Clinic, and then did a hand fellowship in San Antonio with the Hand Center, and practiced 3 years in Southern Illinois, and then moved where I am now in the Quad Cities. We're about 170 miles west of Chicago, right on the Iowa-Illinois border. And came here in 2000 and practiced for the same group for right at 20 years, and decided it was time for a change, and left the group, went off call, left the hospital, started working out of a surgery center 1 day a week, and spent the rest of my time investing in real estate and studying different asset classes. So I did some farm ground in the Midwest in both Illinois and Iowa, and that's a pretty good investment. And then moved into triple net, started out in gas stations, and moved to syndications, and that's when things really blew up for me. It's so easy to create multiple passive income streams when you get into syndication. So it's the key is vetting them very carefully, and getting into some groups where you can get enough deal flow so that you're really getting into good deals. And once you do that, it's a game changer.
Yeah, it's obviously one of the topics that I'm trying to explain people, the benefits and the risks of doing that. But before we go into that, going back to your medical career, surgeons are a big pool of medical doctors that are making a lot of money, and they're also paying a lot of taxes. And I have multiple colleagues that are working really hard in the specialty. They're both, taking call at a hospital, working at the surgery center. They have multiple investments in different, shares in different locations and stuff. But at the end of the year, the tax bill comes in, and a lot of people don't know how to avoid that. Not avoid a tax bill, but avoid paying that much tax. From your experience, with all the investments you started doing and all the, obviously the surgical center incomes and profit sharings and W-2 incomes, where do you think the essential part is someone to focus on in this specialty, in this particular case? What do they need to do, or what do they need to pay attention to in order to decrease their tax bill?
Well, it helps a lot to join groups where you can learn. So you have to take control of your education beyond whatever your surgical discipline is. And for years, I left my investing up to my financial advisor and my tax strategies up to my CPA, or more appropriately, the lack thereof, because most CPAs really don't do much, right? They give you a few little tidbits here and there that are almost meaningless compared to what's available out there. And it's mind-boggling and frustrating when you realize that you spent all those years paying taxes that you didn't have to. And for the people out there that are like, well, that's part of your obligation to society. Well, the reality is I pay a lot more in taxes now, or I'm responsible for the payment of a lot more taxes now than I ever did as an orthopedic surgeon. And I'm making a lot more money now than I ever did as an orthopedic surgeon. But the taxes I pay now are property taxes. So they're coming off above the line, not out of my pocket. So the businesses are generating that as an expense, and we're contributing to society a different way. To me, paying W-2 taxes is the laziest way that you can possibly pay your taxes. There's a lot better way to go. And so paying taxes and creating jobs and housing and contributing to society that way, and paying property taxes is a much better way to go because it's not coming out of your pocket, and your business, the real estate, if you will, is generating that income. So, when you sit down to do the due diligence on a deal and underwrite before you invest, you calculate all that in. And if the business or the real estate or whatever the investment opportunity is can't afford to pay the taxes, along with the insurance and all the other bills, then you pass that one up or you negotiate a better price. And that's key to making all this work and contributing your part to society and still having a pocket full of money at the end of the year, as opposed to losing half of what you earn, which is what I did as an orthopedic surgeon until I learned tax mitigation.
Yeah, I would say this is probably the most important topic to discuss in healthcare professional income, because it doesn't really matter how much money you make if you spend a lot and you pay a lot in taxes. What matters is what you left with, and if you can mitigate a lot of tax burden through strategies like this, you can keep a lot of your money in a legal way.
Right.
Most people think they're like, illegal loopholes that people use, or, kind of a scheme type of thing to avoid paying taxes. And it's not true. It's a tax code that actually help you save some of your money by investing them
Yeah.
in assets
Absolutely.
like this, right? Because at the end of the day, even if you have to pay a certain amount of money in tax liabilities, and you rather invest that money gets deducted from your taxes and also produces you some cash flow, or whatever profits you make on that. How are your peers thinking about this? I'm just curious how in
Well,
your
the ones that
environment, what kind of like mindset?
Yeah, the ones that have an open mind, and can wrap their mind around the investment opportunities, they love it. They come on board and they embrace it. It takes, I think, a certain personality because there's a lot of people that, as you described earlier, that just kind of have the mindset that, if you're doing something like that, then it's got to be illegal. And the reality, as you pointed out, it's all in the tax code, and they've written it that way because they want to incentivize people to do what they want them to do, which is create jobs, create housing, and all of the other avenues that you can go down that create tax benefits. And there are some kind of interesting loopholes, if you will, that don't fit that bill. But the reality is, if you spend time looking into everything and just learn how to pull different levers, some years you'll need a different lever. It's not always the same. So um, when I left my group and dropped back to 1 day a week, and went full time, essentially full time into real estate investing in management of properties, it allowed me to qualify as a real estate professional. So I don't have the usual two buckets that most people have. So most people that are not real estate professionals have a passive bucket and an active bucket. And that's not the end of the world. You can still work with that. You just have to understand it. And so, for instance, if you're a part owner in a surgery center as a limited partner, and you're not actively managing the center, which is true for most surgeons, not all, but some, then that's passive income. So you can invest through a real estate syndication. A syndication is made up of GPs and LPs. The GPs are the general partners. They find the deal, take care of the tenants and toilets, take all the risks, sign for the debt. The limited partners are the people bringing the capital, and so they're partnering together to make this deal work. And the limited partners can receive the depreciation. And so Trump, with the big beautiful bill, just brought 100% bonus depreciation back. So you buy a building, you're able to do a cost segregation. What that does is it segregates all of the 5-year deductions and the 15-year deductions, and those you can push into bonus depreciation. And so the elements that don't work, which include the land and some of the other structures, don't get depreciated in the first year, and they have to go into the long term, depending on what kind of property it is, 27 and a half on a lot of what we do. But everything else is pushed into the first year. So with the 100% bonus depreciation and the right type of property, you can get anywhere from 50 to maybe 90% of your investment. So if you invest as a limited partner into that, say $100,000, and let's just say for the sake of discussion, let's say that you make 100,000 in a surgery center. So you have 100,000 of passive taxable income that you're going to pay taxes on. Let's say that you invest 150,000 as a limited partner into a real estate deal that has 80% of depreciation. That's going to give you about 120 of depreciation, which is a paper loss. So you're actually making money on one side of the fence because you're getting the distributions and the payments with the rent and so forth, depending on what kind of investment it is. And then on the other side, you're getting this K1 that comes to you next year that shows a paper loss. And that loss is just that accelerated depreciation. Why do they do that? Because they want people to invest. Why? Because they want housing. They want medical offices and dental offices and all the things that we supply by doing this. And in return, we're able to get tax-free income from that, and we have excess depreciation that in this case would go over and offset 100% of the taxable obligation for the surgery center. And so that's just one of the many levers. There's other levers that you can do to work on the active tax. And, we could talk literally for days about this because there's just so many different options. And as I said before, it won't always be the same. So if you understand all the different options as your situation changes, then you can reach over and pull a different lever because there's always something that you can do if you don't wait until December 31st, right? So you have
Right.
to be thinking about these things throughout the year, and it just helps to be plugged into a network and a group that keeps you aware of what's available.
Yeah, it's interesting what you said. I want to kind of go back to a few points here. The fact that, the tax, like you said, the tax code incentivizes people to invest in certain assets because the main reason is that the government cannot do it.
Right.
And I totally agree with this, that you would not see apartment buildings built by the government. That's one thing. They don't want to do this because they have no leverage of doing it, and they have no incentive of doing it. That's why they bring other people to the table by giving them an incentive in tax returns to do this work for them.
Right.
The other thing is that it's interesting you said is the tax strategy mindset is that you do not need to wait until December 31st or whatever, April 15th or whatever deadlines they are to file your taxes or think about, oh my God, what am I going to do to not pay taxes? Those things need to be planned and discussed with your financial advisors and CPAs during the year. And, people have 2, 3 meetings actually to kind of put things in order and plan all those tax strategies in time for them to be done by December 31st. It's a very, I would say, less talked about subject in medicine, right? In general, the investment category. And people, learn how to practice medicine, learn how to do surgeries, but we don't learn how to do business. We don't learn how to do investing. These are things that need to be learned in a group, like you said, in a good environment, associate with people that do this, and you learn from them. And also people like yourself who can teach others how to do it. But going back a little bit on your mindset when you started this whole thing, I'm sure things didn't go right well from the beginning, right? And you like anything, right? When you start doing them, can you give us an example of something that didn't go right?
Yeah, so before we talk about that, let me just talk about one other thing that kind of sets the pace. So Tony Robbins did some research looking at the stock market, which is where most doctors are, and the private sector, whether it be real estate or business ventures and so forth. And he found about a 5x difference between that in favor of the private. So, if you think about that, if you're going to be 5xing over here in the private sector, now don't shoot the messenger because I'm using Tony's math, but you could lose 4 out of 5 and still come out okay. And the reality is it's actually over 5x. So if you lose 4 out of 5, according to Tony's math, you're still better off than you would have been in the stock market. And the reality is you're not going to lose 4 out of 5. You're going to lose some because you can't predict everything. So as we go through and we underwrite and we look at the taxes and the insurance and try to do the math on all this to figure out, is this a good investment? Is it going to cash flow? Is everything going to work out? The reality is that we can't predict everything. Things happen. COVID happens. So I had an investment in Atlanta that was struggling quite a bit because in the area where this was located, there was a little bit of maybe a few too many new properties that came to market that kind of hurt the rents a little bit. And some of that you can predict and some you can't. But the big hit there was after COVID, you couldn't evict patients or tenants rather, and so you couldn't get them out. and they didn't have to pay. And so a lot of the tenants in one property we had, they just stopped paying. So we had 50% of our tenant population that was not paying rent, and we couldn't get them out. So, we couldn't remodel the ones that need to be remodeled. We couldn't get a paying tenant in to create cash flow. And so we stayed in a negative cash flow situation there for a very long time. And, finally things started to turn around. And The reality is, as soon as we were able to start evicting a few tenants, then as soon as people found out that they had to pay, they were either going to be kicked out or they had to pay. People started paying. It wasn't that they couldn't pay; they just knew they didn't have to. And so, those are the kind of things that can happen to you, and there's no way to predict that. But there is a very easy way to mitigate the risk, and that is don't put it all in one deal. Don't put it all in one location. Don't put it in all with one lead sponsor. Don't put it all in the same asset class. So, we do marina roll-ups right now. We're doing medical dental office roll-ups. We're doing paving company roll-ups. We're doing multifamily developments in a lot of different locations. We're doing value add multifamily. We've done self-storage. I've invested in vineyards. Used to do a lot of farm ground. So I diversify a lot so that when, one segment's getting pounded, and it's going to happen, they go through cycles, the other ones are doing fine. And so that's the way that you mitigate risk, so that so that you don't get killed when
Yeah.
something happens like that.
Yeah, definitely. Also, talking about the way somebody needs to think about those kind of investments. When you started this whole thing, what kind of education and exposure you had for investing? Because everybody needs to learn from somebody, right? So, what was your story?
Yeah, so I started listening to podcasts just like yours. When you find people that you resonate with, or there's something that you want to learn more, reach out to them. The thing that I find among entrepreneurs and investors, they're very willing to give stuff away, because entrepreneurs aren't worried about dividing the pie, because we just create more pies. And that's the mindset we have. We have a mindset of abundance. And I think that's one of the things that really frees you mentally as you go through this, because if something happens like this disaster in Atlanta after COVID, we can recover from it. We're going to be okay. Everything's going to be fine, because we're approaching this in a very systematic fashion. We're not rolling dice. We're not at Vegas. This is something that we're very carefully looking at. And when you join groups and meet people and go to different types of functions, you'll grow your network over time, and there'll be people that you can reach out to. So if you're looking for a good limited partner investment that you can do passively, you can start calling around and seeing what's available. If you're wanting to do something active, maybe you want to do a short-term rental, which is one way that you can offset some of your active, either W-2 or 1099 income. You can reach out to people that are in that sector and ask them for help, and it's pretty easy to find people that can give you a leg up, or recommend a group or someone else that they know that is putting deals together that are looking for investors. So it's it's a team sport, and that was one of the hard things as an orthopedic surgeon, because we tend to be a little bit of a lone wolf type thing. We're just in the pit taking care of patients day in and day out, and while we reach out for help from time to time, that's not our usual day. But in real estate, that's our usual day. My usual day in real estate is, if I'm looking at a deal and I'm not sure about it, I'll send that out to several people that I know that are very good at underwriting and doing due diligence, and get some feedback on how
Yeah.
comfortable they are with them. And, a lot of times I'll invite them to help me with the deal. And, they're, happy to underwrite it and join in the capital raise if they're comfortable. And if they're not comfortable, then I find out why. And maybe whatever they say makes me uncomfortable. Maybe, but I feel better about it after several other eyes have laid on it. So it's a team sport, and you just want to approach it that way. But what did I do? Started listening to podcasts just like yours, started listening to audio books, getting recommendations, and joining groups and networks, and just listening to webinars, and just soaking up knowledge. And it's not uncommon, as you're listening to some of these presentations, that they're using a bunch of language that you don't know anything about. And so it's like in the industry. You have to learn a new language and figure out what the GP and what's an LP and what's a syndication and what's depreciation and what is cap rates and so forth and so on. And you just Googling these terms and learning them, and you just expand and grow. And as you become more comfortable, it just gets to be more and more fun. It's a little intimidating, honestly, the first year in it. And most physicians would say, well, I really don't have any time. And that's sort of true, but it's only because of the way they manage their time. The reality is we have a lot of time. I wasted so much time in between, sitting in the surgeon's lounge in between cases. God only knows how much I could have learned during that time period if I would have just, checked out and put my earbuds in and listened to an audio book. Same thing when you're driving a car, same thing when you're on the treadmill or running or working out. So it's very rare that I'm in the gym that I'm not listening to an audiobook. I'm reading and listening to audiobooks all the time now. And I just love learning new stuff.
Yeah, it's all about who you surround yourself with, right? And the kind of environment you put yourself in to grow and to learn and to educate yourself. Because nobody says that you need to start throwing money at people or deals, but you need to throw money at yourself first by educating
Absolutely.
yourself.
Yep.
And it's interesting that you said, I was thinking that I don't really know of any example in medicine that someone got a millionaire or very wealthy from medicine. Because most people got wealthy by either investing in a business that grew and did very well, or in real estate. I mean, those are the two avenues that make people wealthy. Yes, you can go in stock market and get lucky, and your company gets an IPO or whatever, and you're done. But these are very small chances, I would say, to get financially wealthy. Now, another thing that comes up really often in our specialties is, people practice for a while, and then you get to a point that you get burned out and you don't want to do it anymore, and you don't have the means to retire comfortably. What do you think people should do to be able to avoid burnout, first of all, and then try to get a head up on the way they can afford retirement? Because I think that's the most, I would say, concerning topic in medical professionals, is that once you stop practicing, you can afford to retire, mostly on W-2 income.
Yeah. So the big question is any given individual going to be able to continue their lifestyle when they reach retirement? And I think a lot of them don't. And I think the answer to both of your questions is the same. I mean, I think that if you'll start educating yourself early on, I wish I would have started this more aggressively at a younger age, but I think if you get more involved with that, create some time pockets. You can block your clinic and block your schedule here and there so that you have time to participate in educational activities, start doing some investing, join some groups, invest with other people that are already ahead of you. That's the easiest way. I mean, if you want to get somewhere, find somebody that's already there and go join their groups, and they're happy to help you up. That's just the nature of entrepreneurs. And I think that if people get involved with those types of activities, it helps with the burnout because now you have another interest, another passion, and it's exciting because you're making a lot of money and you're mitigating a lot of taxes, and you can just see the results of your efforts every year. So
Yeah.
it's truly a win-win type of thing, but it's intimidating, and frankly, I would say the first year is just a little overwhelming. But you just have to, just back up and take a run at it, and just realize it's going to be challenging because you go from, I went from being, kind of the head and the leader and the guy who was writing book chapters and publishing papers and speaking from a podium to the guy that didn't know anything. I couldn't even understand what they were saying. I mean, a lot of the terminology was just pooh right over the top of my head. So I'm back there Googling terminology, just trying to keep up with conversation. So it is intimidating without question. But I think if you join networks, that helps a lot. And then obviously just educating yourself and creating that space, whether it be listening while you're in the car or going to the gym or in between cases or whatever, and just start creating that comfort level because you're going to be uncomfortable until you understand it. And you're not going to be, you're not going to be a very effective investor until you understand it, unless you happen to be in a fantastic group that's just taking you along. And I think that's okay to use that as maybe a crutch for the first year. But the reality is, you need to be trying to learn as much as you possibly can about underwriting and doing due diligence and what to do and what not to do and what to look for and trying to pick out the red flags. And when you get into a situation where you can identify red flags and you get in a situation where you have a lot of deal flow, now you can just start kicking deals out. And that's the key with vetting and getting really good investments is you have to pass up a lot of I don't do good investments anymore. If I don't feel they're great, I don't do them.
Yeah.
Yeah.
No, that's a great point, and I think this brings me to the eternal discussion of passive income. And I challenge you again to discuss this because, in my opinion, the term passive is very weird. Like you said, you can be an LP, a limited partner, and invest some money in a deal, but it doesn't mean that you completely passive. You need to do your own due diligence. You need to do your own
100%.
education. There's time that needs to be involved in this, that, connections and, checking things out and vetting people and, going to see the property. Even if you don't know the, underwriting or how to manage a property or all these things, but you have to do your part as a limited partner. That's hardly passive to me. I mean, the term passive income is a little kind of misnomer for me. I struggle with that term, and that's why I say limited partners it's a better term for me than passive income, because I think everybody needs to understand that any investment has a risk, and if you don't do your job to mitigate all the at least theoretical risks that can be out there by doing it, that's an active job for you as an investor. Another thing that I want to ask you is, like, with all the experience and medical experience and investing experience that you have right now, when you look back when you started this whole thing, what kind of advice would you give to yourself, knowing
Oh,
what you know right now?
yeah, that's easy. I would have joined networks early. I would have pieced off a little bit of that time that I mentioned before, because at one point my practice was so busy. I left before the kids got up, and I came home after they were in bed. It was just, I mean, it wasn't a good environment, and it created a lot of stress on the family. Missed a lot of things that I shouldn't have missed. So I think striking a balance is something the younger generation is a lot better at than we were. I think we had the mindset that, this is our obligation, and if the phone rings, the answer is always yes, we're going to take care of the patient. And the reality is sometimes you have to say, no, we can't take any more here. We're completely full. I've been in the clinic as late as 11 o'clock at night. I remember on that particular night, I asked a patient, the last patient of the day, I said, how long have you been waiting? She said, 5 hours. I mean, it's just was a pathologic situation that I created because the answer was always yes, and I was always driving, to take care of the next patient and do the next surgery and whatever needed to happen. The reality is, if I could go back, or if I could advise someone who's early on in their practice, I would tell them to number one, keep things balanced, regardless of how busy it is. So, I mean, if you're that busy, you need to hire another surgeon. And two, start learning some real estate or other investing options, something beyond the stock market, because you can't mitigate taxes with stocks. You can with businesses and you can with real estate, but you can't with stocks. So you're going to need to be able to control the taxes if you want to really get that steep net worth growth. And you can do that if you mitigate taxes and you do a good job investing and you invest consistently and you try to find those deals that are going to double your money in 5 years or less. And you're going to go through different cycles. So you expect that, when the cycles are not favorable, these things are going to last a little longer and do a little less well and cash flow a little less well. That's okay. Your tenants are still paying off your mortgage. So just ride through those. And when the market gets hot and things are going good, now we're doubling our money every year to 18 months to whatever. And it's amazing how quickly you'll grow your net worth if you get in and be consistent and just take some time to learn the industry. And so I would have started a lot sooner and done it all the way through and just led a balanced life. And that's what I would recommend to people that are starting today.
That's a great definition for success, right? How can people get in touch with you? know more about what you're doing, and also what's new for you this year?
Yeah, so the new one of the new assets that we're doing, well, number one, to answer your first question, timberviewcapital.com is a website. And if they go on to timberviewcapital.com, we have webinar recordings so you can go through, you can look at educational. We have educational talking about different types of investments, education on tax mitigation. We have guests that come in, CPAs and so forth. So a lot of interesting stuff. And even if you're not ready to invest, go ahead and look at all the deals. Just get used to looking at the deals, the terminology, what are we looking for, how have we mitigated risk, and then just follow them along. So a lot of these, you'll see the original launch, this is what we think, and then you'll see the updates later because some of these stay open for a long time. So we have 3 funds running right now that will probably stay open for many, many months before we close. So they're roll-up strategies. So one of them is a medical dental office. We'll continue rolling those up. And so a roll-up is where you just keep doing the same thing over again, building that portfolio until it gets big enough that a REIT or some other large player will step in and pay you a premium for that, for the convenience of not having to go put all those together themselves, right? So it takes a lot of time and energy to go in and vet each one of these individual practices, and vet the tenants and so forth and so on, get them bought, put them together under one umbrella. But they're worth a lot more than the individual component parts. To the big players, they are anyway. So once it gets big enough that it attracts the big players, then that's the bump on the other end. And that's one of the new things we're doing now is we're doing roll-up strategies. So we have one with medical dental offices, we have one with paving company, and we have one with marinas. And all of them are buying those set asset classes and with the intent of putting a portfolio together to get a larger exit on the back end.
That's very interesting. Yeah, it's a great concept, and I was about to ask you about the difference between investing in syndications or triple net leases or anything like that, storage facilities, versus a fund like you just mentioned, where you basically mitigate the risk better by investing in different properties at the same time with the same money. So that's another option. But anyway, I hope people will reach out to you and learn more about what you're doing, and start educating themselves a little bit more, hopefully through this podcast. Thank you so much for being here.
Yeah, you're welcome. Thanks for the invite. Have a great night. Appreciate it.
Are you a busy medical professional striving to excel in life and work? Stellar Success Podcast brings you the habits and insights of top leaders in medicine and beyond. Discover strategies for balance, growth, and fulfillment in every episode. Follow us on Instagram at Stellar Success Podcast for daily inspiration. Start your journey to success today. Subscribe to the YouTube channel now.
That's a wrap on Stellar Success, Leveling Up for Medical Pros with Dr. Tudor Francu. Interested in joining us? Go to stellarsuccesspodcast.com/guest to apply. Stay stellar and level up.